Hello everyone, welcome to Week 5 lecture videos once again. In this video, I will be discussing different models to measure credit risk or default risk. Economists, analysts, and financial institutions managers have employed many different models to assess the default risk on loans and bonds. These models vary from relatively qualitative to highly quantitative models. Further, these models are not mutually exclusive in that and financial institutions manager may use more than one model to reach a credit pricing or a loan quantity rationing decisions. Uh, these models are broadly divided into two categories. One is qualitative models, another is quantitative models. First of all is qualitative models. In the absence of publicly available information on the quality of borrowers, the financial institutions has to assemble information from private sources such as credit and deposit files and or purchase such as information from external sources like credit rating agencies. This information helps a manager make an informal judgment on the probability of default of the borrower and price the loan or debt correctly. So that is qualitative model. In general, the amount of information assembled varies with the size of the potential debt exposure and the cost of collection. However, a number of key factors enter into the credit decision. For example, borrower-specific factors such as reputation, leverage, volatility of earnings, collateral, etc. A brief description on these borrower-specific factors. First of all is reputation. The borrower's reputation involves the borrowing lending history of the credit applicant. If over time the borrower has established a reputation for prompt and timely repayment, this enhances the applicant's attractiveness to the financial institutions. A long-term customer relationship between a borrower and lender forms an implicit contract regarding borrowing and repayment that extends beyond the formal explicit legal contract on which borrower-lender relationship are based. The second one is leverage. The borrower's leverage or capital structure, typically the ratio of debt to equity, affects the probability of its default. This is the case because large amounts of debt, such as bonds and loans, increase the borrower's interest charges and pose a significant claims on its cash flows. Then volatility of earnings, as with leverage, a high volatility in earnings stream increases the probability that the borrower will be unable to meet fixed interest and principal charges for any given capital structure. Consequently, newer firms or firms in high-tech industries with a high earning volatility over time are less attractive credit risk than are those with long and more stable earning histories. Last of all is collateral. As discussed earlier, a key feature in any lending or loan pricing decision is the degree of collateral or assets backing the security of the loan. Many loans and bonds are backed by specific assets should a borrower default on repayment obligations. Mortgage bonds give the bondholder first claim to some specific piece of property of the borrower, normally machineries or buildings. Debentures give a bondholder a more general and more risky claim to the borrower's general assets. Apart from these borrower-specific factors, qualitative model also includes some market-specific factors, for example, business cycle and interest rate labels. First of all is business cycle. The position of the economy in the business cycle phase is enormously important to a financial institution in assessing the probability of borrower default. For example, during recession, firms in the consumer durable goods sector that produce cars and refrigerator or houses do badly compared to those in the non-durable goods sector producing, say, tobacco and foods. The level of interest, um, for example, high interest rates indicate restrictive monetary policy actions by the central bank. Financial institutions not only find funds to finance their lending decision is scarcer and more expensive, also must recognize that high interest rates are correlated with high default risk in general. Now let's move to quantitative model. Quantitative models are typically known as credit scoring models. These credit scoring models are a quantitative model that uses observed borrower characteristics either to calculate a score representing the applicant's probability of default, and by doing so, the model sort borrowers into different default risk classes. By selecting and combining different economic and financial borrower characteristics, a financial institution's manager may be able to numerically establish which factors are important in explaining default risk, evaluate the relative degree or importance of these factors, improve the pricing of default risk, be better able to screen out bad loan applicants, and be in a better position to calculate any reserves needed to meet expected future loan losses. The primary benefit for credit scoring is that the credit lenders can more accurately predict a borrower's performance without having to use more resources. To employ credit scoring models in this manner, the manager must identify objective economic and financial measure of risk for any particular class of borrowers. For consumer debt, the objective characteristics in a credit scoring model might include income, assets, age, occupation, and location. For commercial debt, cash flow information, financial ratios such as debt equity ratio are usually the key factors. After data are identified, a statistical technique quantifies or scores the default risk probability or a default risk classification. Credit scoring models include three broad types: linear probability models, logit models, and linear discriminant models. Now, let's take a brief look at each of these models and their major strengths and weaknesses. First of all is linear probability model. The linear probability model uses past data such as financial ratios as inputs into a model to explain repayment experience on old loans. The relative importance of the factors used in explaining past repayment performance is then used to forecast repayment probabilities on new loans. That is, factors explaining past repayment performance can be used for assessing the probability of repayment, as we discussed earlier. Briefly, if I explain this process, we divide all loans into two observational groups: those that defaulted, so so probability of default equals to 1, and those who did not default, so probability of default equals to 0. Then we relate these observations by linear regression to a set of causal variables that reflect quantitative information about the particular borrower, such as leverage or earnings, and then we estimate the model by linear regression of this form. So we essentially estimate this model. So which means that our dependent variable will be probability of default, which is 1, 0, 1, 0, and so on. And for each of these loan, we have several factors. For example, leverage ratio, profitability, sales, earnings, and so on. We run a regression model and we find out these coefficients. Okay, so this beta is the estimated importance of the particular variable, for example, leverage, in explaining past repayment experience. If we then take these estimated betas and multiply them by the observed variables for a prospective borrowers, we can derive an expected value for this probability of default for the prospective borrower. That value can be interpreted as the probability of default for the borrower, or expected probability, where expected probability will be 1 minus p, which is expected probability of default, where p is the probability of repayment on the loan. Now, logit model. While the technique is straightforward, the linear probability model that we discussed in the last slide, this technique is straightforward as long as the current information on X variable is available for the borrower. However, its major weakness is that the estimated probabilities of default can often lie outside the interval 0 to 1. The logit model overcomes this weakness by restricting the estimated range of default probabilities um, to lie between 0 and 1. Okay, essentially this is done by plugging the estimated value of probability of default from the linear probability model into a particular formula, just to get the probability between 0 to 1, which is more economically and statistically sensical. The last one is Altman discriminant function. While the linear probability and logit models project a value for the expected probability of default if a loan is made, discriminant models divide borrowers into high or low default risk classes contingent on their observed characteristics. Similar to the linear probability models, linear discriminant models use past data as inputs into a model to explain repayment experience on old loans. The relative importance of the factors used in explaining past repayment performance then forecasts whether the loans fall into high or low credit class. Consider the discriminant analysis model developed by Professor Altman for publicly traded manufacturing firm in the United States, and the one that is shown in this slide. The indicator variable Z is an overall measure of the default risk classification of a commercial borrower. This in turn depends on the value of various financial ratios of the borrower and the weighted importance of these ratios based on the past observed experience of defaulting versus non-defaulting borrowers derived from a discriminant analysis model. So this G value is calculated based on these 5 variables, X1, X2, X3, X4, and 5, where X1 is working capital to total asset ratio, X2 is retained earnings to total asset ratio, X3 is EBIT to total asset ratio, X4 is market value of equity divided by book value of liabilities, and X5 is sales to total asset ratio. This model has been estimated and their weight has been generated. Now, the process is when a particular borrower comes in with a loan proposal, we will estimate these ratios for the borrower, and each ratio will be multiplied by the corresponding weight to get a Z value. Okay, the critical value lies from 1.81 to 2.99. So if a Z value is less than 1.81, then the loan will be considered as a high risky loan and should be rejected. Whereas if the Z value is greater than 2.99, then the loan application will be considered as low risky and will be accepted. There are a number of problems in using the discriminant analysis models to make credit risk evaluations. It is worth noting that most of these criticisms also apply to the linear probability model and logit models. The first problem is that these models usually discriminate only between 2 extreme cases. Okay, 2 extreme cases of borrower's behavior, for example, no default and default. However, as we discussed in chapter 4, in the real world, various gradations of default exist, from non-payment or delay of interest payment and to outright default on all promised interest and principal payment and so on. These problems suggest that a more accurate or finely calibrated sorting among borrowers may require defining more classes in the discriminant analysis model. The second problem is that there is no obvious economic reason to expect that the weights in the discriminant function, or more generally, the weights in any credit scoring model will be constant over any but very short periods. The third problem is that these models ignore important, hard to quantify factors that may play a crucial role in the default or no default decision. For example, the reputation of the borrower and the nature of long-term borrower-lender relationships could be important borrower-specific characteristics, as could macroeconomic factors such as the phase of business cycle. However, those are not included in the model. The fourth problem relates to default records kept by financial institutions. Currently, no centralized database on defaulted business loans for proprietary and other reasons exist. That's why we can say that the defaulted loan information or defaulted loan data is not very much widely available information. Now, due to the problems we discussed about the linear discriminant model and Altman discriminant model, there are several newer models available in practice. For example, term structure of credit risk approach, mortality rate approach, RAROC models, option models, and so on. However, we will restrict our discussion to RAROC model only. So we will not go to discuss the other newer models. So let's talk about RAROC model. An increasingly popular model is this RAROC model, which is actually based on market data. The RAROC, which is risk-adjusted return on capital model, was pioneered by Bankers Trust and has now been adopted by virtually all large banks, although with some significant proprietary difference between them. The essential idea behind RAROC is that rather than evaluating the actual or contractually promised annual rate of return on a loan, that is net interest income and fees divided by amount lent, the lending officer balances expected interest and fees income against the loan's expected risk. So you can say the loan income is not divided by the amount of loan, rather than it is divided by loan at risk or capital at risk. Thus, rather than dividing annual loan income by assets lent, it is divided by some measure of asset at risk, or what is often called capital at risk, since unexpected loan losses have to be written off against the financial institution's capital. So this is the formula for the risk-adjusted return on capital. Now, how this is used to approve or reject a loan: if RAROC is greater than the benchmark return, for example, return on equity for a bank, then the loan proposal will be accepted. And if RAROC is less than the benchmark return on capital, then it will be rejected. Now, risk-adjusted return on capital, you can see that 1 year loan divided by loan risk. So loan at risk. This loan at risk essentially is calculated in a manner similar to the duration model that we learned in week 3. So in duration model, if you can remember, we have seen that how the given change in interest rate can have an impact on the value of assets or market value of assets. So in the similar manner, in this model, we find out that for a given change in credit quality, how much the value of the loan is affected. right? Now, how the credit quality is measured? Credit quality is measured as the spread between the rate of return on a loan and a benchmark rate of return. For example, treasury bill rate. Let's say treasury bill rate is 3% and the rate of return on a loan is 5%. So the spread is 2%. Now, if this spread increases, which means that the credit quality declines, then that will have a negative impact on the value of the loan. And you can see that duration of the loan is also considered in a similar fashion as the duration model. Okay, so in short, in this RAROC model, risk-adjusted return on capital model, we find out the risk-adjusted return on capital by dividing the interest income by a loan at risk, and loan at risk is calculated in the same manner we calculated the effect of interest rate change on the value of an asset, and here we find out the effect of changes in the credit quality on the loan value. Okay, so that's the end of our discussion on the different models to measure credit risk. Thank you very much for watching the video.